Irwin Simon is joining us here on Market on Close. Great to have you on, Mr. Simon. Big day for you guys, providing some much needed relief to a beleaguered sector in stock price. So your guys' big differentiator here is that you're making profits 2 quarters in a row. Tell us what the key is getting that revenue down to the bottom line.
So good afternoon. Thank you for having me on. Listen, the key is to sell product, to sell your brands, and manufacture the product at a low cost. And that is number one, your grow and your yield and your production to be able to be a low cost producer. And a lot has happened at Aphria over the last 6 months. In regards to Aphria 1, we have over 600,000 plants in there, so utilization of the grow facility. We have brought in a lot of automation in regards to our processing, and with that, that's going to help us with our cost. The next thing is our brands, and consumers are buying our brands. Matter of fact, our share in Ontario on our Soleil brand grew to 12%. In regards to our Broken Coast brand, it's one of the most demanded super premium brands out there. So it's about sales, it's about controlling your costs, it's about putting out a great product that consumers want, and it's about ultimately expanding your distribution.
How, Irwin, can you sort of address the operating kind of margins of this company? Do you know yet? Can you put your finger on where it's going to be? I know that for a new company and a new industry, it's vacillated quite a bit. If you were to just look at a gross margin on a quarterly basis, it bounces around. You now have had 2 profits in a row, though. Can you start to get an idea of how this business will operate? Can you give us an idea what that might look like, that margin, in a year from now?
Sure. I think the most important thing is we had 2 profits in a row, and we, had organic growth in both of those quarters on our profits. So that's important. But if you look at Aphria today, we did $126 million in the quarter, and also there were some, great numbers that came out of our European operations, RCC Pharma, which ultimately will be selling a lot more medical cannabis, which will help our margins there. That's a lower margin business today, so we should see margins dramatically grow in that business. In regards to, Aphria 1, we just, by the end of July is when we got most of our plants in place. So I'm looking for some, high margins, and that's because ultimately we'll have Aphria Diamond on board. We'll be growing 265,000 kilos in 2.5 million square feet. So it's going to be about the yield, the processing, our labor cost, and last but not least, the distribution. And that's going to be key, is how we distribute our products to the stores. So, I'm looking for high margins. I like margins with 4 handles or 5 handles in front of them.
Okay. Talking CAD here, $1.35 cash cost per gram of dried cannabis. That's down from $1.48, to your point about the efficiencies of your guys' production of the pot. That's a big deal, as I know a lot of other signs we see with more production happening in a legal market, that prices sold will also probably continue to come down. How close do you think we are in the Canadian market to stability in pot price per gram?
Listen, we still have a long way to go. This is only a year since, rec cannabis has been legal. And, with that, Aphria 1 has really only been in operations, the full operations, for about 6 months. And we don't have our Aphria Diamond in operation. So it's going to be, another year to really get all the costs, the kinks out of it, get the labor costs. But I think, we're on track here. Just in pre-rolls, when we had, our pre-rolls, in regards to that, we do 4 a minute by manual. Now, as we bring in equipment, we'll do 5,000 an hour. So automation's going to be key here. The other big thing is, no one has really grown cannabis in a 1.4 million square foot facility. And growing cannabis, has not been easy in a greenhouse, in regards to the lighting, in regards, to the way you water your plants and irrigation. So getting those yields on the plants are going to be so important. The other big thing, as I said before, is the different strains. And what you can't do is have complexity in this business. And how do you take complexity out? And with that, ultimately, how do we turn our cash flow? And I'm big on cash. How do we turn our products to our consumers and customers and how do we get the reorders? And that's a lot what we're working on right now.
When we look at the battle basically that's taking place, we're just looking at the chart of your guys' stock with everybody else's, and after this earnings, now on a year-to-date basis, you're the best performer because obviously there's been a very high sort of correlation trade after the big lofty run-ups we had. But I'm curious, Irwin, if you stay out in front and you maintain that cash that you're talking about, is there M&A potential, or is that too much of a cost burden at this point? I know there were discussions about, and you spoke earlier in the year about possibly looking into some of CanTrust business as they went through their own negative headlines. So what's the status on potential acquisitions or bolts-on?
Listen, there's good potential acquisitions out there. There's over 200 LPs in the Canadian market. And with that, consolidation is something that's inevitable that's out there. But, you know, where my focus is if we're going to do acquisitions, it's got to be accretive, it got to have organic growth, it's got to generate cash, and it's not going to be a burn on our capital here. And we ultimately got to need the capacity. Right now, we have plenty of capacity with both Aphria 1 and Diamond. And with that, that's what we're going to focus on, is getting that 255,000 kilos out of there and getting the yields and getting the processing right. But to your point is there is acquisitions out there. If there's, you know, additional patients to acquire, something like that, you know, at Aphria, we're going to be opportunistic and look at those acquisitions and opportunities. But it's got to be accretive to our shareholders, and it's got to be accretive in organic growth to us, and we're not going to bring on someone else's cash burn.
This is why I'm kind of curious about the stock price. And I know most CEOs kind of hesitate from discussing stock action, but just generally speaking, I wonder if investors can expect the chance of such a deal going up if your stock price continues to depart from your peers. Can you use that stock price to your advantage in M&A if you really start to break away?
Listen, even if it's stock, it's paper, it's still currency, it's still cash, and you never want to do a dilutive, you know, acquisition to your shareholders. And I think what's important, you know, from the Canadian market is this here: if we commit to $1 billion in size, do we have enough capacity with our current assets? But is there some other great brands out there that will give us a jump start? You know, today our medical business has tremendous opportunities, and should we be doing that ourselves and growing it ourselves, or is there acquisitions out there that would give us that jump start? But again, I want to emphasize, we're only going to do deals that are organic growth opportunities there and that are accretive to earnings, and there's no cash burn. Listen, with that, even if my stock, you know, was trading at, you know, 10 times sales, or et cetera, I still would not do a deal if there was a cash burn and it was not accretive to earnings. Okay,
very good to know. I'm sure investors like to hear that. Well, I got another question here about the relationship between suppliers and other parts of this economy that's developing. Aphria terminated the supply pact with you guys earlier in the month. I know you've commented on this before, said you're disappointed, but that this was not, you know, materially affecting the company's business. I guess my question is, how much of the supply chain do you want to own, though, and is there a risk point in more departures like that?
So number one is, as I said, I want to be a consumer packaged good company in the cannabis world. I want to focus and build around my brands. You know, I want to be a great grower, a great processor, and a great developer and seller of brands. You know, in regards to, you know, the whole Aphria thing, hey, we're a large shareholder. We wanted to live up to our commitment in regards to our agreement. It was a legacy deal that was, you know, done before I got here. In regards to not having our license at Diamond, that is one of the issues we, you know, were not able to supply them. We felt that we would be able to supply them, but, you know, I think they felt they could go elsewhere, and they were the one that terminated the contract. So it was every bit of our intention to stick to the contract and supply. Maybe not on their terms from a timing standpoint, but, you know, I'm disappointed that they went ahead in the area they did. And listen, on the other hand, you know, we feel using that capacity now to fulfill our brand demand and other products out there, that's something that we'll do.
All right, looking forward to continuing the conversation. Appreciate the candor and the wrap up here on the earnings. Irwin Simon, really good stuff. Thanks a lot.
Thank you.
You got it, sir. Irwin is the CEO at Aphria Shares.